Hello, everyone. This is Stephen Richardson, and tonight we're going to be talking about stock selection guide, basics for beginners, adding judgment. As you recall, our last lesson was about the quality check, and if the stock was up, right, and parallel in its lines of sales and pre-tax profit and earnings per share, then it was okay to move on to the judgment. If it wasn't up, right, and parallel, you shouldn't waste your time. So now we're going to move on to adding judgment. Here's a standard disclaimer. I'm not offering any financial advice, and these views are my own views. This is for educational purposes only. Okay, what's in a stock selection guide tonight? Add your judgment to the SSG. This probably looks familiar. This was from the same quality check. You can see that the sales, pre-tax profit, and earnings per share are up, right, and straight in parallel. Tonight we're going to be filling in that forecast for historical sales and historical EPS. We're going to forecast what we think it will be in 5 years. And there's several ways to do this, and we're going to find out exactly how to do that. So, your sales and EPS projections. First, you need to understand what the company does to make money. And you can find that out in the annual report or the quarterly report. Then you identify the items that drive and or challenge future growth. How wide is its moat? How narrow is its moat? Does it have new products in the pipeline? If it's a drug manufacturer, what trials do they have, and what stages of the trials they have the drugs in the pipeline? Um, Car manufacturer, are they coming out with something new? So you want to identify that because they have something new coming out that could increase their sales and make the sales steady. Uh, the most recent trends, growth, and generally considered to be most relevant. So you can look at what happened 5 and 10 years ago, but the most recent is really what's impactful because it's what the company is doing these last quarters and this last year, maybe the last 2 years, what their direction is. Usually, CEOs are around for a minimum of 3 years or longer, and they really can't start ramping up with their ideas, implementing at least for a couple of years. It takes time. Um, and growth generally will grow as the company gets larger. You're going to have exponential rapid growth as a small company. And then when you move into becoming a medium company after 1 billion in sales, it'll start to normalize, hopefully still going up and increasing. And then once you get to a large company, 10 billion, once that company becomes a large company, then these sales will start to no, not flatten, but be not as sharp. A good rule of thumb is to limit growth projections to 15 to 20%. And so I put a little snip here of where you can find these projections. Value Line is the go to for investors. Value Line takes the latest quarterly report or annual report and pulls information from it and then discusses that and what their analyst thinks about it. Value Line is indispensable. You should do not walk to your library, get a library card, and log in so you can use their subscription to check out Value Line for the stock that you're um, evaluating. Same with Morningstar. Invaluable information. You can go to your library. They usually have a subscription online. And another one, Yahoo is free. You can go to Yahoo or Zax, Seeking Alpha, Market Watch. Um, but I was going to say that another report that's kind of rare to find because it takes a subscription is the Standard and Poor's Global Net Advantage. It's also called the Stars Report because it reports how many stars, how valuable a stock is. And I happen to have a subscription for Johnson County Library in Kansas, in Johnson County, Kansas. That's an area in Kansas City, a suburb county, and they offer the Stars Report, and it's extremely valuable. Okay, so the snip on the bottom here is fundamental company data. Those green boxes is where you're going to put your projection of what you think based on looking at the different analysts and the most recent sales and earnings. And then it based on that, it projects out the 5-year estimate for where the sales should be, for example, at a 13.8% growth, where it should be in 5 years. And for EPS, a 23.8% growth, where that should be in 5 years. Okay, after you've done that and you know where your growth is headed for sales, where you think it's headed for sales and earnings per share, now it's time to estimate the future price earnings projections, the high and the low. This one is the high, and I've got an entire class dedicated to um, price earnings ratios. So this is just a really quick one for beginners. You remove any price earning ratios that do not seem to fit significantly higher or lower from the historical average. And you see the snip below the number three price earnings history, and it goes back 5 years. And if there's anything anomalous, you can click on it and a red diagonal line will appear and it'll take that information out from the calculation. And then it gives you a 5-year average for the high, 5-year average for the low, the current trailing 12-month average for high and low, and then the future or the average 5-year average earnings ratio, which is the high and the low plus the low divided by two. Um, and this, when I clicked on that green box, this popped up for sales. This popped up I mean, for high on the price earnings ratio, and I'm just making uh, conservative guess that 32 is where the future price earnings ratio is going to be. 5-year average is 31.9, and the current is 33.8. So it's very conservative. So it multiplies that by your high earnings per share forecast. This was based on your sales, which you calculated, and it comes to a high price of 7.99. So you think this stock is going to reach 7.99. And if you notice in this price three closing price on the day, this was January 19th when I snipped this, it closed at 383. So based on your projections, you think it can get to 800. And what I like to do is I like to go to Morningstar and I'll click on this stock and go for the past 5 years and see where the price has gone. If it's gone up and down, if it's steadily gone up, can it reach 800? I'll take a look at that for myself. Okay, then the future price earnings projections low. When you click on the low box, the low green box, this pops up, and um, I'm it's so they give you the 5-year average low, the 5-year average price earnings, and the current price earnings. So this is the lowest you think it could go. So I'm saying 20. 20 times 11.33. That's the low EPS, what it currently is. And that brings us to 226. That I think it could go to 226 if it was low. And again, this is from getting information from other sources and making your judgment. Okay, the buy criteria. Buy only when the stock selection guide says the stock is in the buy zone based on your projections. And these are conservative here. The zoning is 25% for buy, 50% for hold, and the top 25% for sell. And buy only when the upside downside ratio is 3 to 1 or higher. This is a 2.7 to 1. So it's barely, you can see it's barely in the hold zone. If it has a bad day, it might come back down in the buy zone. A portfolio that grows 15% compounded annually will double your money in 5 years. Again, stock selection guide basics for beginners. Judgment. Use uh, the quality check and the judgment together to determine if you should buy the stock. And once you get to that that buy that that ratio of 3 to 1 or greater, now it's time to dig into the annual reports and the stock and the quarterly reports to see more information about this company and answer any questions that you have about any anomalous things. Um, if you like what you saw, then click the subscribe button. And also, we do backyard musings for current events and edgy commentary, and law school dash essentials, outlines of select Cal Bar exam questions. If you know a law student, let them know. Thanks and have a great day. Bye.